I've looked at 100 mortgage applications that were denied from across the country, and I've identified 6 specific reasons why those mortgages got denied. And this is coming from myself with over 20 years in the mortgage business and helping over 6,000 people buy a home. I want to help you avoid these 6 mistakes. Without further explanation, let's jump into the first reason. Let's jump right into number 1, and it's inconsistent income. Let me give you a little bit of a definition on this. Where I see inconsistent income would be maybe someone who has base pay and you have an opportunity to make commission, but there's no consistency in that commission income, meaning they just took a new job and the income opportunity is great and the commission is going to be great and everything works out, their income is going to be awesome, but that hasn't happened yet. So as a lender, I'm not allowed to use your commission income unless there's been a consistency of it. I see sometimes where someone goes from a salary job making X to they go to Y making half as much, but they've got a bunch of upside with commission. Well, if they haven't earned that commission, it hasn't played out yet and it can't be used. In most cases, 1 year of commission can often be used. When we get to 2, we can use it for sure. Another inconsistent income piece is time on job, steady job, no gaps between employment. So I'll give you an example. It is okay to move from one job to another. Not a problem at all. A short period of time between job A and job B isn't a big deal. But when you see a jump from one job to another job to another job to another job and gaps in between, there's some concern of the consistency of income, because if you don't have money coming in every month, it's tough to pay the bills. We've done deals before where someone literally quits their job or is fired in the weeks leading up to closing, and guess what? We were still able to work through that. And the reason why, they got a new job, and that new job did not have a probationary period, and the income was the same or the income was better. It doesn't mean you can't switch jobs. It doesn't mean it's not okay to switch jobs, because it is. It's just understanding that and having the goal that the lender needs to see consistent income, consistent earning ability, so you can pay your monthly bills. There's not a lot of gray area in the mortgage business. A lot of it is black and white, and there are some areas of gray, but really it's black and white. And with income, we have to show the ability that you've been earning this income for an extended period of time. Another example would be overtime income. It is okay to use overtime income, and you can actually qualify using overtime income if you've earned overtime for an extended period of time. If over the last couple years, overtime was a regular thing and the year-to-date pay shows that that overtime is going to continue, we can then qualify you using that overtime income. Big thing, how much money is coming in every month and how much is going out. We as a lender need to know how much is coming in that we can qualify. Now, in some cases, you don't have to use all the income and there's a bigger gap. There's lots of room where we don't have to use the overtime. We can just use the base pay. No problem. The issue is, as houses get more expensive, as people are spending more of their money for housing, numbers are getting tighter and tighter. So it's critical you're working with a lender that understands those numbers, understands your income, and explains it to you really clear to make sure you're well qualified to buy that house. If you're 3 to 6 months out from looking at a house, I'd look really hard at staying at the job you're at and not looking at making a move. I would look at making sure you're working at least the average hours you have in the past so you don't see your income drop. So the whole issue with declining income. It's great you made this year, it's great you made it year before, but this year the number came down considerably. At the time of shooting this video, it's early in 2025. So those first couple months of the years, if your income dropped, the concern is, well, maybe that's a new income. Maybe they're getting hit by the economy and their income's only here instead of where it was in the past. So one of the biggest advices I would give to you is to make sure that you're cranking out those hours and making sure that that income, to as much as you can control it, is as high as it's been in years prior. The second reason that your mortgage application is getting denied or can be denied is because of undisclosed debt. Every single lender, whether it's me in the mortgage company that I own, whether it's Bank of America or Wells Fargo or Chase Bank or anyone, they all play by the same general rules for mortgages. And mortgages get packaged up to meet a set of guidelines and then sent off to a secondary market, and that money's then replenished. It's replenished to the banks, it's replenished to the mortgage lenders, so they can turn around and lend that again to someone else. These very defined guidelines set up what is debt and what is their income. What comes into debt is this undisclosed debt. Undisclosed debt is, let's talk about what regular debt is first. Talk about car loans. We talk about credit cards. We talk about your mortgage payment. Those set obligations that you have that show up really clear on your credit report, the standard debts that you'd have. Maybe you got a consumer loan, maybe student loans, whatever else. So those are those standard debts that we see that are really easy. What sneaks in sometimes are these undisclosed debts. Debts that someone forgot about, they didn't know about, they brushed under the rug and just thought it was going to go away. And suddenly, when you're under contract to buy a house, this undisclosed debt rears its ugly head to come in and potentially kill a deal. Couple examples of undisclosed debt. Maybe you had a dispute with an apartment complex years ago and they filed a judgment. And that judgment's trailing and it's hanging out there on your credit report. Maybe some old medical debts, the same thing that never got resolved that are hanging out there. We see child support payments that are out there that may or may not be accurate, but they have to be addressed. All kinds of issues are out there. The earlier that you can understand what's out there and take a look at it to get ahead of it, the better, so it doesn't blow up your mortgage application in the 11th hour. I suggest looking at this stuff and looking at your credit report ahead of time with a mortgage professional. It's funny doing this as long as I have. People usually come to me after they go find the shiny object, the new house. What really should happen is a big conversation with a qualified mortgage professional to understand that full credit profile and see if you have any undisclosed debt that could potentially blow up your purchase. The third reason why your mortgage application could get denied has to do with credit report, and oftentimes which can be inaccurate information on your credit report, or maybe some disputes that you've had in the past that you're given some bad advice. Oh, just dispute that and it'll go away. Given enough time, inaccurate issues can be fixed on credit reports. And the issue is time. And I bring that up because if you don't look at credit in advance, you don't understand your credit score, but also what's on your credit report in advance, you may not have enough time to correct it. There's unique things in the mortgage business that we as a mortgage professional can correct inaccurate information, and we can do so rapidly. Here's something most people don't know. Most mortgage lenders won't do that work. You know why they won't do that work? Because they can't charge you, the customer, for extra work they did to clear up your credit report. I will tell you, over the years, I've literally spent hundreds and hundreds of dollars correcting inaccurate information. My competitors in the market would not do that work because they couldn't get the fee from you. I look at it as the cost of doing business, and let's get the information correct. If your mortgage professional really knows what they're doing, they're going to dig into that credit report. When something's inaccurate, they will work with you to get it fixed. Yes, you can send a letter, and yes, you can dispute it, and yes, you can wait until it reports next time. This typically takes months and months and months. If the information is inaccurate, that mortgage professional, if they're willing to spend a little bit of money and time, can get that corrected in a matter of weeks instead of a matter of months. Now, a matter of weeks doesn't seem like much time, but I tell you what, if you're under contract to buy a house and it's closing in just a few weeks, a couple weeks is the difference of getting your deal done and buying that home or not. So to have that conversation sooner than later is critical. What you can also do is look at possibility improving your credit score along the way, where at this level you may only qualify for a couple different programs. With a couple subtle changes, you may qualify for a whole new option of programs, giving you better interest rates, better programs, a whole variety of things if you do the work ahead of time with a professional. One of the best examples I can get when talking about credit inaccuracies or credit disputes are divorces. And one thing that I've seen very common in divorce a lot of divorces lead to credit issues down the road. In the divorce settlement, there's very clear parameters that are set. Who's responsible to pay what? Who's responsible for this? Who's going to take the house? Who's taking the car? If we have time and we have this information from the divorce decree and we can show who's responsible for what, who's been paying and who hasn't been paying, many times we can get someone in the right direction. They can still get approved, even though on paper their credit doesn't look that good. Great example of talking to a professional and taking a look at things in advance instead of the 11th hour. The fourth reason why many mortgages can get denied is not enough cash on hand to get everything done. Inadequate cash required to wrap things up. Now, when we talk about funds required at closing, okay, great, I'm putting 20% down on a $200,000 house. Cool, I need $40,000. Well, that's $40,000, but guess what? There's closing costs. And there's things we're paying in advance, prepaid, setting up escrow accounts, paying the first year's homeowner's insurance, paying for an appraisal, paying lending costs, paying realtor costs, realtor admin costs. There's a variety of costs. So beyond a down payment are the other costs that are out there. In addition, some loan programs require that you have extra money left over after you buy the house, called reserves. An example, buying a rental property requires reserves. If maybe your credit score is a little bit lower, you could possibly still get a loan done if you had compensating factors. Like compensating factor example would be, you have enough to get this done, you can afford the payment, but boy, your credit doesn't look very good. But guess what? I have 3 months of my payments set off to the side in savings. That's a compensating factor that I have extra reserves. So down payment, closing costs, prepaids. Does the loan that you're looking at using, does it require you have additional cash? Here's the great thing on cash. You don't really need the money until closing day. So oftentimes when I'm working with a client that we don't have enough cash, we've had great conversations along the way, such as, I'm getting a bonus for about $2,000, and that's going to happen about 10 days before closing. That $2,000 might be enough to get them over the line. And if we have a conversation about that, the money is coming and it's going to be there. We will continue to move that train down the tracks towards closing, knowing the money's coming in a little late and a little hot, but it's going to be there. So good communication, understanding the numbers, knowing exactly what the requirements are, down payment, closing costs, prepaids, and anything else, and get ahead of that. Here's a good rule of thumb to keep in mind to avoid you from falling into this trap. Have a very detailed conversation with your mortgage professional well ahead of time, because maybe you're just putting 3% down or 5%. Maybe you qualify for a zero down program. I've got a bunch of videos on those programs, but whatever that is, take a look at what you're looking at for down payment, build a little extra cushion, hope for the best, plan for the worst, but having that conversation ahead of time is going to keep you from falling into this trap. The fifth reason why mortgage applications across the industry get denied is inaccurate or incomplete paperwork. I've said this my entire life. There are great financial advisors and there are horrible financial advisors. There are good divorce attorneys, there are bad divorce attorneys, there are good attorneys in general and bad attorneys. In the same cases with mortgage professionals. I think our industry, which I've been in for over 23 years, has that same thing, good and bad. And I will tell you, the industry has moved to a bank teller position. And I don't mean any disrespect to bank teller, but bank teller is more of an entry-level position. A good mortgage professional knows how to read tax returns. A good mortgage professional knows how to squeeze some extra income, look at some debt options, look at some different loan programs, and understand everything we need in a file. Too often, all the paperwork comes in and that file gets denied because we're missing something, missing a W-2. Maybe they don't have the tax returns. Maybe they can't put this piece and this piece together. Oftentimes they can't put it together because they haven't had the depth of knowledge of the mortgage industry and how to get something across the finish line. Inaccurate paperwork, can't get it done, can't fill in the gaps, loan denied. Working with someone that understands the business, can understand how to get all the details put together and get you across the finish line is critical. It's not just about the low-cost provider and some .com company that isn't going to get it done for you. So that's from the lender side. Let me give you an idea and a suggestion for you as potential buyer. Get your ducks in a row. Get your information set ahead of time. A couple pay stubs, a couple W-2s, your 401k statements, your bank statements. If you're getting a gift from someone, put the details together of that gift for your down payment, all those details. When I do a mortgage, I'm a very good mortgage client because I have all my ducks in a row. Anytime I do financing, all my ducks are in a row because I know the difference between a good client and a bad client. And I tell you what, putting your stuff together, being on point, have all your documents together will make it a paid experience for you and for the lender helping you out. Reading between the lines of incomplete paperwork to get the loan approved and to get it done. Here's something I've heard over my career. I already sent you that. You already have it. You don't need any more. I couldn't possibly give you more information. I will tell you, if you're that client that says, I've already given it to you, I can't give you more, what else could you possibly have? Those are probably the files and the clients that end up without a house because mortgage regulation is very deep and can be very complex, especially if you have complex income or tax returns or everything else. If you say, I'm not giving you more, guess what? Your file is probably heading to the incomplete file and didn't close. I can tell you, your lender doesn't want to call and ask for more information any more than you want to give it. So if you want the loan, get them what they need, get it in a timely manner if you want to be the homeowner. The sixth issue why your mortgage application may blow up has nothing to do with you. It has to do with the property you're attempting to buy. There can be issues with that property. Issues as simple as maybe it's not worth what you were willing to pay for it. When an appraiser comes out and they look at the property, they may find the substantial difference between what you're willing to buy it for, what someone was willing to sell it for, and what this third party thinks the property's for in an open market. Now, appraisers are sometimes wrong, and that could be the case, or it might be right. They may have saved you from overpaying. It might allow you to go back and renegotiate to a lower price, or maybe not, but that's an issue. Other issues include unique properties. It's a super cool house. It's super unique. Well, if there aren't other homes that have sold like that, you might not be able to buy that home. There's a whole variety of things, and I don't want to bore you with 22 years of mortgage industry experience and all that things I've seen property related, but that's number 6 for the reasons why your mortgage application could blow up. It's because of the property, not because of you. Now, it might be a little heartbreaking at the time when this comes up, but if you look at it as an optimist, and I'm a constant optimist, this prevented you from buying something that you could have a really hard time selling down the road. And I've talked about some other videos about renovation loans and taking ugly homes and making them beautiful. And there's a whole other program and guidelines for that. If you want to check out one of my other videos, take a look at that regarding renovation financing. Now you know a handful of items of things to look at to not be denied your mortgage application. My big takeaway is this. It is imperative to find a professional to help you with this process. Not all mortgage lenders are equal or created the same. Find a good mortgage professional that's going to help you accomplish your goals so you don't end up getting blown up and your mortgage pre-approval getting denied in the 11th hour. So if you found this information helpful and you're thinking you're ready to take the next step and you want to see how much you could afford for a home, check out my video to see exactly that, how much you can afford for a home.